Hi, welcome everyone to this Friday webinar. We have a very well-known and very interesting guest today, Mr. Siddhartha Bhaiyya. He needs no introduction. He's managing director and CIO for last 11 years with Aequitas Investment Consultants, which has been actually topping charts in the space of small case PMS and AIF products. He's a dear friend, and I know him since very long. This is the third webinar that we are doing with Siddharth. And the talk of the town, the talk of the city today is that small caps are expensive. I see almost all mutual fund advisors, because we know the fraternity is kind of very big in terms of mutual fund advisors, are talking to their clients, moving money from small caps to multi caps or large caps, because everybody feels and believes and is giving this piece of advice based on past crashes that we have seen in the space of small caps, as we saw in 2018, 19, 20, or we saw in 2008. Everybody wants to kind of protect themselves from any upcoming, I would say, any crash that happens in the space of small caps, because obviously small caps have risen a lot. In terms of valuations, though, small caps do not look scary, but yes, this is the exact topic that we want to hear today from Siddharth, who is our dear speaker today. That are we really seeing small caps at a scary level, or kind of this is a misnomer and we need to have a different perspective. I think Siddharth just by mistake got logged out. We'll wait for him to join back and then we'll continue from here. Yes, Siddharth is back. So Siddharth, I think you heard the entire introduction.
Yes.
So before I take further time, I will kind of hand it over to you to give your opening remarks on what's your perspective, and then we'll do it as a Q&A. I have a lot of thoughts on my mind with regards to what I need to ask you on behalf of my entire team as well as our entire client base. But
Okay.
Happy to hear your opening remarks.
No, Kamal, so to be honest with you, okay, let's go back to March 2020. The small cap index had gone through a very tough time. Nobody wanted to invest in small cap at that point in time. In fact, small caps were considered as kachara, right? And all people wanted to do was invest into very few concentrated stocks, which were the Rithik stocks. And people felt that these are the stocks which are only going to give you return over the next 10 to 15 years, and the other stocks are not going to do well. And here we are 3.5 years later, where the small cap index itself has rallied 500% from the March 2020 bottoms. And today we are at the other spectrum where people want to buy any small and mid cap. People are willing to speculate into IPOs, into the SME index. So from being, the only thing I want to say is in March 2020, the narrative around India, around small caps was very negative, but the valuations were right. Today, the narratives around small and mid caps is extremely good, but the valuations are wrong. And I tend to buy into bad news and good valuations and sell into good news and bad valuations. So my sense is India as a country, I've invested in, my entire net worth is in India. I've invested for more than 20 years into India, and it's a fantastic wealth creation journey that we've all experienced as far as not just the Nifty, but the small and mid cap space is also concerned. But we need to be cautious. We need to be careful. There are a lot of fly-by-night operators who are coming, a lot of IPOs. A lot of these are going to get eventually delisted over a period of time. So be very, very careful while investing in small and mid caps.
Sure. Very recently I was hearing a post on social media whereby Aequitas is also stopped taking inflows. Earlier I was talking to Preetpal, one of your, I think, head of sales, who told me that you have raised your ticket size from 10 crores to 25 crores.
Yes.
Then all of a sudden I kind of checked over social media that you have stopped taking inflows. That itself kind of, was throwing your, I would say, apprehension with regards to valuations. So I would want to know more, about the thought process behind that as well, because that will give me, what is your overall thinking at the moment.
Yeah, again, as I said, Kamal, to be honest with you, we are bullish on the long-term prospects of India. Correct. Indian markets Whether it is 2001, whether it is 2009, whether it is 2020, markets are way higher than what they were in the past. But in the meantime, you can have extremely deep and volatile. The small cap index fell by nearly 80% in the global financial crisis. Small cap index was not there in 2001, but the entire small cap basket was at 3-4 times earnings in 2001. For that matter, during COVID, the small cap index fell by 55%. So what I'm saying is, long term we will do well. Right now, valuations for us are not attractive. We have certain benchmarks in terms of what we want to achieve in terms of returns. And if we feel that we cannot achieve those kind of returns, then we would rather not take money.
Sure. So, those investors who are already invested with you in Aequitas, what is the stance that you're maintaining with those guys in terms of cash levels or profit booking or top ups? So how are you kind of, advising your existing clients?
See, so we have started creating some cash in our portfolios. But again, as I said, at the same time, I'm bullish on the long-term prospects. A lot of our existing investors are sitting on huge unrealized gains. There's a lot of margin of safety, right? And typically, we would rather hold stocks through correction. Like some of our holdings, we've been holding for more than 10 and a half years now. And we've seen multiple corrections of 30% along the way in some of those stocks. But to own multi-baggers, you have to hold them for a very long period of time. Multi-baggers don't happen in 6 months or 9 months or 1 year. Multi-baggers take 5 years, 10 years, and then the power of compounding kicks in. So we're very comfortable. We will see, right? Is this the bull market top? I don't know. The markets can rally even further from these levels, right? The only thing, as I said, Kamal, is we demand certain margin of safety as far as stock investment is concerned, which we don't find right now.
Sure. So to my knowledge, I have never ever seen large caps, not correcting and mid and small caps correcting. Though I agree that for a while, in markets were narrow, there were few large cap stocks which kind of were showing resilience when small caps were correcting more. But for markets to, if small caps will see correction, then large caps will also correct. So if that is the scenario, then, why is it that, one should not invest in small caps at the moment and one should maybe invest in large caps?
In fact, what I would say is typically large caps don't correct that much. It is the small caps that in a bull market, small caps tend to outperform large caps. But in a bear market, it is the Nifty never corrects by 50% or 70% or this, but the entire index, small cap index, corrects by that much. So typically small cap investing is a very long-term game, and it should not come as a majority of the money into small cap comes in at bull market peaks. So as I said, the time to invest in small caps may be after a little bit of correction. Nifty might correct 8 to 10%, but small caps could correct 20%. Who knows, right? Typically, small caps will correct more than their beta. Their beta is always higher than the large cap index.
What are the factors in your, I would say, analytics or research, which you see culminating and becoming reasons for this correction?
So, Kamal, the thing is, investing is all about the future. And nobody has a crystal ball, according to me. March 2020, nobody could have forecasted that these are the kind of returns that the stock markets would have given during the dark days of March 2020, during COVID. And the same thing right now is we don't know what the future holds. So how do you protect yourself best against the future? You protect yourself best against the future by buying stocks at a deep discount to their intrinsic value, by ensuring margin of safety. So even if things go wrong, and right now there is no margin of safety in a lot of stocks that I see.
So are there any pockets in the space of mid and small cap which you are still comfortable holding and maintaining, I would say, high conviction positions in your portfolios?
So we have high conviction portfolios. We've been early investors in manufacturing, in infrastructure, in capital goods, and we expect these companies to continue to do well. But a lot of these stocks have gone up 8x and 10x in the last couple of years. There's been an 800 to 1000% rally in some of our stocks. And at some point in time, either we would expect a pullback or a little bit of sideways correction. Correct? Bull markets typically have to last 3, 5, 7 years in a particular sector. It cannot get over in 2 years. So you will have pullbacks, you will have sideways correction. And if the economy continues to remain strong, then the stocks will go up. See, typically what happens in a bull markets is stocks run up ahead of the earnings. Right? The stock rises more than what the earnings rises. Then at some point in time, there is a correction when reality sinks in that earnings are not rising at the same pace. Then again, earnings rise, and in anticipation of that, the stocks rise. So stocks will always lead the earnings, but at the same time, there will always be over enthusiasm on the upside, and there will be pullbacks and checks, and then as the earnings catch up, the stocks will again start going up.
Tell me one thing, in your case, your PMS, to begin with, when the ticket size was 10 crores, what is the logic for having a ticket size of 10 crores versus say 2 crore or 50 lakhs? Because many investors ask us this question. I agree that it's a small cap focused portfolio and you want to kind of, make it available to a certain class of audience and not to a retail class of audience.
Correct.
But still, 10 crore is a too, I would say, bigger ticket size. What is the thought?
What we do is we're not index huggers. We're here to make absolute returns for our clients, right? And that at times might involve taking bold calls, involve taking extremely contrarian decisions, like the decision to invest into infrastructure or capital goods 3.5, 4 years back was extremely contrarian. And if we have too many clients, how do we communicate with them? There is a restriction on the number of touch points that we can have as an organization. Today in our PMS, we are managing money for 70 families. Okay, and across 120 odd folios, and which is 3,000 average 40 crores per family. Now the point is, what we are doing, if tomorrow there's a crash, they can call us up or we can call them up. Anyone who's giving 50 lakhs to a PMS, according to me, while for a PMS, if some 50 lakh comes into 3,200 crores, for that PMS it is irrelevant. But for that individual, it could be his life savings or a significant chunk of his liquid net worth. So while we have nothing against why we don't do it, but what we do is extremely contrarian, right? Justifying some of the holdings that we held in March 2020 to a wider base would not have been possible. Today everything looks good, but at that point in time, some of our holdings, nobody believed it. So no other reason except for the fact that we want to communicate with our clients because of the manner in which we operate. And then if you really want to, as I said, that's the only reason, to be honest with you.
Sure.
And also, Kamal, one thing is we don't have a model portfolio approach. We build customized portfolios for clients. I own certain stocks which have gone up 8x and 10x in our this. If I have a model portfolio approach, then I would have been buying the same stocks for them even today, which I think is unfair.
Oh, sure. So Siddharth, the stocks that you own or you invest in are mostly, I would say, deep value stocks.
Yes.
Because obviously, valuation is one factor that you kind of focus upon. But I do see various other fund managers, I would not like to name them, who are kind of trying to find balance between growth and value. And their portfolios have not run up that much. And if I go sector wise, for example, specialty chemical sector is a growth sector primarily, right? So if we say there are many value stocks in infrastructure and PSUs which have run up a lot, or in defense which have run up a lot, but in specialty chemicals, many good businesses which are growth businesses have not run up a lot, and they are also small cap and mid cap businesses. So when you're saying that there could be a correction happening, Would you kind of perceive or believe that there may not be a holistic correction this time, because we are seeing macro levels actually improving from here on? Generally speaking, corrections broadly happen when there is a macro problem, like pandemic was a macro problem, subprime crisis was a macro problem, increase in interest rates was a macro problem. Now in next 6 months there could be only one macro risk, which is elections, which also seems to be an opportunity. And at the same time, interest rate cycle could be reversing. So if macro problem is not going to be there, then there could be a change of sectors or maybe change of style from value to growth, and the rally may continue. Wouldn't you kind of
So Kamal, to be honest with you, markets never peak out on bad news. Markets always peak out on good news. In 2007, when the markets peaked, there was no global financial crisis. In fact, the markets bottomed during the global financial crisis. Right? The markets bottomed during COVID. The markets bottomed during 9/11. Markets always peak on good news, and market always bottom on bad news. Right? Coming to whether there's going to be a change of style, there's going to be, again, coming to growth, right? Growth investing, if you've bought, you cannot justify, typically in what I've noticed is, once a company is done well for 4 or 5 years and profitability is grown at a very rapid pace, your PE multiples also tend to expand. And at that point in time, the stocks become liquid and people try and justify them as growth stocks. But the fact of the matter is that historical growth is already captured into the stock price. It is the future growth that matters. You look at infrastructure. Today, the only sector that is growing really, really fast is infrastructure and capital goods. These were not growth stocks 3, 4, 5 years back. Now they've become growth stocks. Okay, some of these stocks have gone up 30x, 40x. Their QIPs are happening, their OFSs are happening, and they are no longer value stocks. They have become popular names right now. So the point what I'm saying is, historical growth doesn't matter. What matters is future growth. Your Asian Paints was a very fast growing company, or at least people tend to confuse growth in share price with growth in with growth companies. No, growth companies are companies whose revenues and profitability is growing at a faster pace, not the stock price. You getting me? So the growth, the future growth matters. Future to a large extent is unpredictable. And how do you capture that? You can capture that through margin of safety by buying value.
Sure. At this moment, one, I would say, red flag, which I could see, which may trigger or which may accentuate correction in the small cap space, is the, I would say, massive rise in the AUMs of small cap mutual funds.
Correct.
Right. So that is one factor which I also kind of consider maybe not being visible at the moment and becoming the reason of correction eventually. Yeah. What are your views in this regards?
No, I think March 2020, I was the only small cap fund manager who was left. Everybody moved to large caps, or every small cap fund manager had launched large cap schemes. So look, we continue to believe in the space. We're long-term small cap and mid cap investors, and that's our forte, and that will continue to remain that. Correct? We believe that we understand the space well. And right now, again, as I said, the only reason we have stopped inflows is because we find the valuations wrong. Once the valuations improve, we will re-enter.
What is your, I would say, comfortable level? After how much correction you think valuations will become relatively comfortable to you?
Again, it's very difficult to say that, Kamal. Today, the small cap index has touched and trailing 12-month PE of more than 30 times. Like the same price to book is 3 times. At March 2020 bottoms, it was like 0.5 times price to book. So, as I said, it's very difficult for me to put out a level. For all you know, the index might rally another 20% from these levels. I don't know. I've got no idea. Correct? But then it would be absolute insanity if prices were to rise even from these levels. And markets can be irrational for longer than you can stay solvent. So I'm not going to bet against the markets. The economy is very strong. but I would just advise a little bit of caution at these levels.
What is your view on FIIs, coming back to India and kind of giving any support in case any such correction happens, or you think FIIs will continue their selling if correction happens from here?
Again, as I said, I have, once that situation arises, we'll act accordingly. Very difficult to forecast that markets are going to correct and FIIs are going to come. I have no idea. I'll be very honest with you. So, the biggest problem is a lot of people try and forecast a lot of things. Right? Whereas I just look at the current thing and say, okay, the valuations are very high, and I don't find any margin of safety at current levels, and I'm not going to invest more.
If you're so confident, why would you not maintain cash levels as high as a 50% in your portfolio?
Again, as I said, I'm bullish on the long-term story. When I started my career, Kamal, Sensex was at 2,800. Today, the Sensex is at 21,000. But if I would have invested in 2007 or 1999 peak or 2007 peak or 2020 peak just before 2019 peak before the COVID, or 2017 in small caps, I would not have made money. It is when you invest, okay, the duration is very important. I'm a firm believer that you should do an SIP and everything. But if you go lock, stock and barrel into small and mid caps at this point in time, right, it's not a good dish. So I'm very bullish from a long-term perspective. Short-term, I don't, what I hold in my portfolio, I'm completely, personally at a personal level, I'm 100% invested in the stock markets right now. But am I willing to put in more money? No, I'm not willing to put in more money.
So you, by mistake, mentioned that currently markets are at 21,000 levels, but they are at 70,000 levels.
I'm talking about Nifty, 21,000.
Sure. Perfect. So at current levels of, market valuations, I again ask this question: what is the cash level that you will want to maintain? If not, as high as 50%, then what is that number?
Again, as I said, as a fund manager, you can never have a 50% cash. Show me one fund manager who has 50% cash. Right? You can go. You're not here to take such bold or dramatic calls. All I can tell you is last 4.5 years, we've had 0% cash. We've been fully invested. Not one day have we had 0% cash, and it's worked out well for us. We've made a lot of money for our clients. Our portfolio is up 600% in the last 3.5-4 years. We will take some money off the table for our clients, and if we feel, we'll redeploy it at the right levels.
Sure. So going back to your own portfolio, which is Aequitas portfolio, I'm believing your personal portfolio is also aligned to the Aequitas portfolio. As you mentioned, you have a significant skin in the game and you are fully invested in equity.
Yeah, in fact, I invest only in our AIF. I don't do direct equities anymore.
Sure. So let's try and understand, what is your view sector-wise in terms of your discomfort with valuations. I'm not talking about, because this webinar is not turning into, optimism. This is turning into giving a caution, which is not a bad thing. It's a stance that you're wanting to maintain. So from that point of view, let's, try and understand your discomfort. Which are top 3 sectors, starting from, I would say, top sector to third sector, in terms of your discomfort?
I think overall, you look at it, Kamal, most of the sectors are priced to perfection. Whether it is pharma, you barely find any stocks at less than 25 times earnings. You look at capital goods and infra today, stocks are at 25, 30 times earnings. You look at financials, most of the stocks, maybe, in fact, except for the large cap banks, a lot of financials are at 20 plus 20 times earnings. You look at PSUs, the rally that has happened, these were untouchables 2.5 years back. Nobody wanted to touch them at 10% dividend yields. Today, something like a fact has a market cap of 78,000 crores. It's a loss-making company. ITI, has been perpetually loss-making. Today, it has a market cap of, I don't know what, 35, 40,000 crores. And today, people want to buy everything. Nobody wanted to buy State Bank of India. Today, people want to buy all public sector banks. So what I'm saying is, while again, as I said, PSUs are doing extremely well, and they might continue to do well in the long run. But the short run, they've run up quite a bit. You can have sharp pullbacks, and people can lose a lot of money. You take money at 100, it goes to 70, and from the 70, if it goes to 200, then you have only doubled the money. But if you take money at 70, you practically end up tripling the money. So I would like to buy when there is blood on the street and sell when there is too much euphoria.
Sure. So let's see, what are your projections? Obviously, as you rightly mentioned, people do forecast. You would not want to forecast, and forecasting is absolutely, I would say, unwise. But still, for the discussion's sake, because I'm sure some levels you will have in your mind for your own personal portfolio as well. We are kind of ending this year, right? So as we'll be ending, say, year 2024, what are your forecasts? How do you see year 2024 panning out and maybe ending? I'm not talking about 1 month, 2 months. I'm talking about one full year.
Probably my sense is 2024 could be a negative year for the Indian markets.
Sure.
So I could be wrong. Again, as you said, right? It's just, we've had 4 years of fantastic rally as far as the stock market is concerned. From March 2020 till now, nearly 4 years, markets have rallied only one way. We've not had a single correction in the last 4 years, 3.5, 4 years. And for a lot of time, people were just waiting for a correction to come in. And this is an example of where people were expecting a correction to come in, no correction came in. And now people have thrown in the towel and jumped in lock, stock and barrel into the markets.
But Siddharth, I also have 2 decades of experience. If I tell you, in 2008, when market corrected, that time the PE of market was around, Nifty was around 27, 28. Even in 2019, when market corrected, the PE was 27, 28.
Correct.
Today, the PE is around 22. And I know 22 is also expensive PE. It's not cheap. If PE was less than 20,
as of now, the Sensex PE multiple is 25, right? And if anything, we're just only 10% away from the peak multiples that you're talking about. And why should I wait for the last straw? Correct. Why should I? As I said, the markets will do well in the long run. My concern, I'm not saying that the markets will not do well in the long run, but after 4 years of fantastic rally in the bull markets, maybe we'll have a flat year, maybe we'll have a marginally negative year. I don't know.
Sure. But what is your view on interest rate scenario over, let's say, 1 year?
I think interest rates will continue to remain around these levels. I don't see massive, domestically at least, I see real interest rates going up because there is a lot of demand for credit. After, I think for the first time in 4 years, your systemic liquidity has actually gone into deficit. Yesterday's liquidity deficit number was 2.5 lakh crores. The peak was 12 lakh crores of liquidity surplus. So, there is the economy is booming. There is demand for credit, and you could see, the real interest rates going up domestically.
Sure.
The RBI might not increase interest rates, might not decrease interest rate, but at the same time, real interest rates, the cost of borrowing for you and me, and for corporates and retail, can go up.
So, I have been interviewing, I would say, more than hundreds of fund managers, and you have also been watching, our webinars. And I represent clients' interest. And on this webinar, we are giving a pessimistic stance. Absolutely, you are a thought leader, and your word becomes a piece of advice. But yes, I would caution all the audience that one should take one's own well-informed investment decision. And in that stride, Siddharth, I will ask you one question, which I want to ask. Don't take me wrong. What happens at times, it could be the case that, while you are giving the stance of market being expensive is sounding logically correct, because we know, yes, small caps have rallied, people have made money. But you also would want small caps to correct for you to add more. And if such stance comes out from a thought leader that markets are expensive, it will lead to some kind of correction, and it will create a room for you to kind of enter.
You know what? The one thing I'll tell you, I'll be very honest with you. Nobody can move the market. The market is supreme. Okay, if I could have willed the market up, I would have willed the market up in March 2020 itself. Nobody can, right? Market is far, far, far more supreme than any single individual. I cannot influence a single stock, let alone the markets. So while I would want to feel flattered, I don't think so. I call a spade, Kamal, right? I don't live on hope. I can go wrong, and I've always publicly stated that I give my opinions, whether it is on Twitter or whether it is on webinars. I give my opinion, right? People are free to watch them or not watch them. If I go wrong, I'm not accountable to anyone, right? If I go right, I do not go and thump my chest.
Absolutely, this is I would say very well said. But we are living in a social media I would say driven world, and things go viral. And today we have more than 10 crore investors, and 90% of investors, more than 90% of investors are kind of new investors who have come in this last bull run which we saw after COVID. Obviously, from their point of view, when a thought leader says like this, it could become, I would say, an execution. So obviously, we have to keep that aspect also in mind. But though I agree with you that yes, your stance is logical, but again, when we say macros, I'm unable to actually perceive that what is the negative outcome, what is the negative event that is ahead of us.
Kamal, I want to ask you one thing. March 2020, right, when the small cap index was at 8,700. Could you foresee 3.5 years later that the small cap index would be at 43,000?
No, obviously no. Yeah.
So precisely the point. What I'm saying is, you and me cannot foresee the future. What can go wrong? I don't know. You getting me? I cannot say what can go wrong as far as the macros are concerned. The macros are extremely, extremely good at this point in time. And macros were extremely, extremely bad in March 2020. Everything was wrong about India in March 2020. Correct? People wanted to invest in NASDAQ. People wanted to invest in China. Nobody wanted to invest in India. I travel abroad. I travel the world. Go meet global investors, and nobody wanted to invest in India. So I'm saying is I might have called it too early. The bull market might go on from these levels also. I don't know. I'm bullish on India. I am a long-term investor in India, right? I do not find enough money-making opportunities. I seek multi-baggers. I'm not here for 20-30% kind of returns. I'm here to find multi-baggers. And if I cannot find multi-baggers, I will not take more money.
Sure. So no, I agree with you. In 2020, there was a lot of pessimism, and hence the only thing that could have happened was optimism. And now there is only optimism, and you are saying that the thing which can happen is pessimism. Like in optimism in 2020 was.
I'm not saying that, Kamal. I'm saying.
Agreed. But the only point is, while in 2020 we were in a pessimistic scenario, and things started turning optimistic over a period of 6 months. From there on, it was kind of there were a lot of reasons, like I would say fall in interest rates, opening up of economy, people accepting equity as an asset class, people after going through, I would say, sentimental shock, started spending more. They started living life with more, not procrastinating their needs, but spending more and kind of fulfilling their needs today after COVID, right? So that led to a kind of again a power-packed economy. And then obviously we had a backing of so many wise.
We are all talking about this with the benefit of hindsight. Nobody predicted this way back in March 2020. That the hotel industry is going to go through this kind of a bull run. The airline industry is going to go through this The great Warren Buffett sold his stock. I'm a big fan of his. He's my guru. Right? If the best can go wrong, who am I? So what I'm saying is, whatever you're saying is with the benefit of hindsight. Nobody told me that in March 2020 or 21 or 22 is what I'm trying to tell you. And again, please don't get me wrong. I'm not negative. I'm not pessimistic. I'm not this. Right? It's my individual decision not to take money flows. Right? There are other fund managers who might have different specialities, who might be growth investors, and who might find opportunities, who might feel that growth is not done well and might do well going forward. It's their call. My individual call at a firm level, the decision that we have taken is we do not believe that we can make a lot of money for our clients. Maybe we will be able to make money for clients, but the risk reward is not, worth our time and efforts.
Sure, fair point. So that's so we'll move on. Let me try and understand from you, in your now portfolio management stance, you cannot sit on too much cash because obviously your perspective on India is long term. And I agree with you. As a fund manager, you cannot take such bold call because at the end of the day, you are in a fiduciary responsibility of your clients. But yes, at this moment, you have stopped taking new money because you're not comfortable with levels. You also mentioned that you would like to invest in multi-baggers. Now, in the overall context, I am getting this understanding that you are trying to create a multi-bagger from the point of view of price. But what I have learned in my 2 decades of career is that multi-baggers are discovered from the point of view of growth in business and growth in earnings. So in today's scenario where India is expected to grow from 3.5-4 trillion to 6 trillion, aren't you able to find out such multi-bagger businesses which will continue to grow at say 20-30% growth of their business earnings, and hence they are multi-baggers? Why would you pessimistically say that you cannot find enough multi-baggers where you can multiply money at say 25-26%, which is like 10x in 10 years?
Growth in economy has got nothing to do with, if growth in economy had to do with the stock markets, then why is the Chinese stock market underperformed for the last 15 years? China has grown massively forget the last 2-3 years. Right? So India will continue to do well for the next 5 years. But the point is, a lot of the 5-year growth is already forecasted into the stock price. The point I'm trying to reiterate again and again, Kamal, is that a lot of the good news is already factored into the stock price. Today, managements come out and give 20-30 guidance, and the stocks rally 40% in 2 days, and everything is captured in day one. So yes, the economy will continue to do well. At this point, the Indian stock markets will continue to do well. But at this point in time, I do not find, and again, as I said, this is a market, right? You have 2 decades of experience, I have 2 decades of experience, and our perspectives can be different. And I respect your perspective. But my perspective is, at this point in time, all the good news as far as India is concerned is captured into the stock price. The markets can rally even from these levels. And I was bullish on small caps before COVID happened. And my portfolio tumbled 30% from those levels during 1 month. Who could have predicted that? And then so markets can rally another 30-40% from these levels. I can't predict it. Like Newton said, you can predict the movement of the stars, but you cannot predict the insanity of stock markets. So markets can be rational for longer than you can stay solvent. And if the market continues to rally on the upside, so be it. It's good for our existing investors.
Sure. So let's try and kind of project future. I'm going to be kind of not wanting you to think of any magic, but if I would say election results are say optimistic, if interest rate starts to fall, because both these factors are important.
Well, again, as I said,
to be optimistic.
The point you're trying to say is the economy will continue to do well. The outlook is rosy. I'm saying the outlook is rosy. Our differing view here is that See, you and me cannot will the market where it is going to go. The point what I'm trying to say is the economy is going to do well. Economy is doing well. It's just that I focus on valuations. Valuations don't fit my zone. I don't want to, there's something called as risk reward. And the risk reward is not suitable for me at this point in time.
Sure. Fair point. So out of two options, if I give you, there will be price correction or there will be time correction, or there will be more price correction and less time correction. What will you go for over, say, next, when you say 2024 will be a negative year and you're not comfortable with valuations, but you have focus on earnings, which you are optimistic about, which means, there will be some correction. Now, that correction will be time correction or price correction, or more of price correction and less of time correction.
I have no idea, Kamal. I have no idea how this is going to. I had no idea in March 2020 that my portfolio will be up 600%. I knew from this. I know from this that okay, we can have correction. I don't know whether it's going to be a time correction or a price correction or both. It's very, very difficult to, and again, as I said, you are saying that I can this. I don't want to give out, wrong messages to people. All I'm here I don't want to give out any levels because I don't want people to take action on that. All here I'm trying to tell people that the markets have run up quite a bit. The valuations are expensive. It is time to be cautious. That is it. I wish I could give you an answer. And if I knew that answer, then I would act accordingly. I would sell today and buy at that level that day. You can't predict the next day's market. Forget about predicting what is going to happen in the next 1 year.
Sure. So last 40 minutes, we have actually given our audience full, I would say, perspective of why Aequitas has stopped taking money, and what is the view that you, as one of the thought leaders in the space of small cap, has, and what is the, I would say, detailed understanding behind that perspective. Now, in next 10 minutes, I believe in what you are saying. I agree with what you are saying, and I would kind of logically agree with whatever you are saying. Let's kind of go 1 year ahead and see, and kind of, I would say, anticipate that corrections have happened. Now, how will you decide to enter again, or what sectors you would like to enter again, and where will you be focusing upon? We are talking about specialty chemicals, EV, or maybe the older stories like defense. But I'm sure as correction happens, you will obviously be seeing with one lens of again trying to enter, and you will have to do some homework before that in your mind, in your thesis, in your research.
So Kamal, we hold stocks for 10 years, but we research them every single day. People talk about holding stocks for 10 years and churn their portfolio every single month. The point what I'm saying is we track the markets, we track the news, we track the companies, we track the economy on a single day. We are a team of 9 people who's reading newspapers and corporate announcements and global newspapers and global news sites on every single day basis. We react to situations rather than anticipating or trying to forecast them. So as and when situations evolve, we will. If you would have asked me a month back, I would not have said that I'm planning to stop my inflows before the elections. But after the elections, the Nifty is rallied 12%. State elections. The small cap index, which was already rallied 30%, has rallied another 10-12%. Right? 6 months if the small cap index is rallied 50%. So what we will do is we will evaluate the situation as and when it unfolds, and hopefully we'll react first to the situation.
Sure.
Yeah.
So at present, valuations are expensive. You are giving a cautious call, word of caution to investors with regards to the space of small caps, and that is why you have stopped taking inflows.
That's it.
As we are now kind of approaching year end. This is kind of a year end webinar. What is your final word of suggestion or advice generically, or I would say holistically or particularly to investors, given your 2 decades of experience? I'm not talking about particularly any levels or views about
See,
future prediction.
my advice to people is invest in a sensible manner. Stock market is about investing in companies. It is not a gambling den. Please avoid derivatives. Please, avoid speculating in IPOs for listing gains. Okay, India is a great long-term wealth creation story. Okay, but the only people who have made money are people who have invested from a long-term perspective. So do your own research, invest in a very sensible manner. Is all I will tell people.
Would
Right?
you advise investors in timing the market?
I don't personally time the markets. I do an SIP. I invest every single month into the markets through our own funds. My salary goes into our own AIF. So timing the market is futile. SIP is the best way to keep on, building your wealth over a period of time.
So I think we are concluding this webinar and kind of coming to the final set of couple of questions. There have been a lot of questions that I see from the chat box. Where one of the question where it's being asked, what is we should take a valuation session with Siddharth. Maybe this time, if you can cover it sector wise. You have given your overall view, but if you could give some sector wise perspective also on valuations, that will also kind of, I would say, elaborate your thought.
No, as I said, historically, now in historical context, Nifty is at the higher end of the small caps are today now more expensive than the Nifty. So I would say from a risk reward perspective, maybe large caps are a better long term bet at these levels. Okay, and you know, as I said, it's just that the markets have rallied too much, and we would just be careful. I have nothing to say as far as individual this is concerned.
Would you advise advisors like us or wealth managers or private bankers to evaluate their investor portfolios and realign their allocations from small caps to say large caps?
Again, it will it will all depend upon the risk profile of an individual investor. Correct. It will all depend upon when you have invested. So for a lot of our earlier clients, where they're sitting on 95% of the money that we are managing, 90% of the money that we're managing for some of our earlier clients is the profits that we are making for them. So for them, the risk reward profile is very different from somebody who's just come and say a year and a half back, even for our own clients. So it'll all be a function of how much time you've been in the markets, what is your risk taking capability, what are your obligations, what are your liabilities, what are your income stream. And I think, Kamal, you and your team are much better placed than me to take a call on that.
Absolutely. I really appreciate your viewpoint about our team. Absolutely, you are doing a good work. And calling you as one of the thought leaders and inviting you for this webinar is also our fortune, because we keep learning from every fund manager who is keeping a very, I would say, vivid eye on stock market. And you are definitely one very great fund manager. And then obviously you have had your experiences of 2 decades. And that is the reason at this juncture we called you, because we tend to agree with your view. And while we are advising our clients, we are also trying to advise them to either invest through STP, like you are talking about SIP, or maybe selecting a flexi cap portfolio to a fully small cap portfolio, or maybe trying to invest in small cap over a period of time. So absolutely, we are very cautious advisors. We also understand market valuations and everything, but yes, getting a perspective from a fund manager who is managing money definitely kind of reiterates the perspective, and that is the reason we thought of doing this session with you. It has been really insightful and interesting conversing with you overall in this webinar. And then yes, the perspective that you have given, the suggestions that you have given are all kind of for education purposes. We are not going to hold you for any kind of anticipations or any forecasts. Absolutely. So please do not have any such thought. This is all just for learning, and in the form of my moderation, I have to try and kind of go inside your mind to try and understand what is it that you are thinking, and that is what is my role and what is
no
expected out of me. And that's why, I would like again ask you a question again and again, but I do value your views, and I know that is the reason we kept this topic when we kind of planned this webinar. And thank you so much for joining for this webinar. We will again maybe look forward to doing webinar with you after 3 months, and let's see how future pans out.
Surely.
Absolutely. So it has been really pleasure, and thank you everyone for joining us for this webinar today. This was a very insightful webinar. For any further conversations or any further interactions with regards to investments, you are most welcome to kind of join PMS AIF World. You can log into PMS AIF World and book appointments with us. We are very experienced, I would say, professionals in the space of alternatives, and hence we can guide you really well, handhold you really well with regards to helping you making well-informed investment decisions. Thank you once again.